Well, it looks like the Federal Reserve decided to throw the baby, the economy, out with the bathwater, inflation, all while using an old playbook for a new ball game. When it comes to the stock market, gravity's a funny thing. We found out this year trees don't grow to the sky, and what goes up must come down. When it comes to the economy in general, confidence and sentiment, I think, is the name of the game. Not looking good right now. But when it comes to the real estate market, the good news is back to gravity when it comes to interest rates. What goes up must come down. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. Hope you had a great week. All right, well, the Federal Reserve, the controlled demolition of our economy continues. Looks like they did throw the baby out with the bathwater, the baby being the economy, the bathwater being inflation, and they are certainly using an old playbook for a new game. What I mean by this is last time we saw inflation at these levels, there was not $5 trillion printed and dumped into the economy. That was more of a naturalized core inflation back then, from my understanding. But they definitely got this wrong, and I think it's pretty safe to say that at this point. They certainly just have their blinders on when it comes to inflation. And if they think that we're ever getting back to 2% inflation while counting housing in the inflation number, I don't think that can ever happen because there's a shortage on housing. So as I mentioned last week, let's start to look at inflation. Just like we take out food and energy, take out housing, which they're now starting to call shelter. Another thing with their moves this year, as I mentioned earlier in the year, they should have ripped the Band-Aid off and went 200-300 basis points. They didn't. That would have given them the opportunity to do some backtracking right now, but now they're on their path. They look like they're set, and they've gone too high too fast. Listen, if we had this move up in interest rates over the course of 2 years, the economy would have time to digest it and make sense of it. But right now, the market literally cannot digest what the Federal Reserve has done because it's been too much too fast. And they should have known that the consumer is eventually going to get tired. They did mention that they couldn't fight the core inflation of food and energy, so I really don't know what they're doing at this point. They should have waited for things, as I've been mentioning, to settle down after the $5 trillion dump into the economy. Give it a couple years to work itself through. They had it right. Nobody wants to say they had it right, but they did have it right. Inflation was limited, for a lack of better. But if they fix a couple of other things, consumer demand is way down, they'll see inflation come right down. And I do believe at this point the Federal Reserve has lost control of markets and the economy. I think, again, they're using an old playbook for a new game, and that certainly, as we know, is not going to work. All right, stock market. I want to say right now, officially in bear territory on all the major indexes. We were there last June, maybe a hair off on the Dow, but the S&P and the NASDAQ were then and have been since in bear territory. But now the big headline on the news tonight will be the Dow, because that's what everybody watches if they open up the newspaper. But here's the thing about the stock market. Let's say the Dow's down 20%. The damage is really done internally, where some of the major issues, some of the major stocks, are down 70 to 90% off their peaks. So the internals internally are way worse than the headline number. And I'm sure everybody that opens up their portfolio this afternoon is going to agree with that. Something else about this year, I think we can safely say that the experts, quote unquote, know nothing more than the average person. I challenge somebody to tell me that different because I never heard anyone at the beginning of the year say to sell. Everything's always been buy the dip. We've had the buy the dip mentality for about 14 years now. And it's pretty safe to say the experts know nothing more than your average person. Otherwise, what happened this year to some people's portfolios definitely wouldn't have happened. And just when it comes to the stock market in general, I think I was talking about this about a year ago. Profit taking did have to happen at some point. Again, trees don't grow to the sky. And when somebody's up 500 to 1,000% on a stock they bought 10 years ago, what was their goal? They're probably looking for 30, 40%, and they got 5 or 10 times their money. And now they're realizing trees don't grow to the sky, and they're selling. Moving on, confidence and sentiment, which I think in life, for that matter, is everything. When it comes to confidence and sentiment, you can see what's going on with the Treasury yields, which are now Forget about inverted. They are literally upside down. The shortest maturing treasuries have a higher yield than the longer maturing treasuries. That is literally a sign of the R word, and I'll say it today, recession, because we've been in one. You just had to look at the shipping and logistics companies' warnings they gave last week. But the treasury yields, just, go online and look it up. What happens when yields are inverted? Forget about that. What happens when yield curve is literally upside down? That means no one knows anything, can't forecast anything, and we know uncertainty certainly begets selling. So, when it comes to confidence and sentiment, the consumer is not happy right now in any place of the economy that I can see. And we have a funny economy right now. I'll read one article. It says we have a shortage of workers. I'll read another article that says that we're getting layoffs. Here's the issue with that. I believe the shortage of workers is happening in industries where it's more of a job than a career. And I think the layoffs are happening in places where it's more of a career than a job. That's not going to be good for confidence and sentiment. That's not going to be good for the economy moving forward. Now, historically speaking, where rates are today, if you look at a 50-year chart, what's gone on this year is literally a blip on the radar, but it's a funny thing. Let's say something's at 6%, for example. 6% coming down from 7% a party. 6% coming up from 3% is no party at all. So historically speaking, interest rates are still attractive, but it's all about what you're used to, and we're used to interest rates roughly about half of where they are right now. The consumer got really stretched, as I was mentioning earlier this year. It could not keep up. Everyone was looking at old data when they were referencing the consumer, coming off of what we came out of the last couple of years. The consumer got so stretched for basic utilities. The demand for voluntary things, as I talked about a few weeks ago, voluntary inflation, where you can choose to participate or not to participate in it. The consumer has chosen not to participate in a lot of areas where there's voluntary inflation because they got so far stretched on what they needed to do every month that the Federal Reserve definitely should have noticed that. I'm really not sure why they didn't. They basically discounted the fact that the consumer would get tired much quicker than they thought, and now we're seeing that reflected in a lot of numbers. Moving on to housing and mortgages, I've used this line before. 2008 called, they want their mortgage rates back. Here's the thing, mortgage rates have shot straight up this year. That, to me, is a classic technical, it's going to fall, and I'll tell you why. It's got no real support on this move up. If you look at a chart, it's literally a straight shot up with a couple of blips down, but they're small blips. And technically speaking, there's no basis for support. So if there's an event that happens, little known to us what that could be, you will see yields come down maybe 50 or 100 basis points in one day, depending on the calamity that could occur to move yields down, because there is no real support for this. The Federal Reserve has scared everybody to the point of wanting to take their ball and go home. But I'll tell you this, just like the stock market, when it comes to the bond market, gravity's a real thing. What goes up must come down, and there's no real support for this. Now here's the thing about housing right now, which I'm going to start referring to as shelter. If you're going to gain your shelter through buying a home with a mortgage, it's teetering on the brink of unaffordability right now. I think this could be the top of it, maybe a little bit more damage to the upside, but I think when the move down happens, it'll happen pretty quick. But here's the thing again, rent for people's shelter is the great unknown, because at least when you have a mortgage and it's a 30-year mortgage, your worst case scenario is in place, and if you have the opportunity to refinance in the future, well, it's only going to get better from there. When it comes to rent, in theory, there's literally no cap on the move up, and that could make shelter/housing look like buying is still better than renting. Okay, everybody, that is my show for this week. I hope you enjoyed it. Always, any mortgage related questions, please reach out to me. Thanks again for watching. Have a great weekend. And